Good morning, good afternoon, and good evening to everyone from wherever in the world you may be joining us today. We have guests here today joining us from Gambia, Germany, Gabon, Nigeria, Barbados, the US, the UK, and places even as remote as Bloemfontein, South Africa. I'm joined here today by my two colleagues who will be the experts on our panel, Joe Toast and David Roberts. Our topic today is wide enough to cover a year of university at a very expensive university in the US. However, we've decided to narrow it down to two broad topics. The first one being US estate duty payable on any US basis, any US situs assets, which will be applicable if you own any US assets in excess of $60,000, which with the South African equivalent being roughly R1 million. And then we'll also look to briefly discuss those youth of which went to seek greener pastures in the US, but remains beneficiaries of foreign trust. Foreign trust, that being, of course, for US tax purposes. The purpose of today is to provide you with a high-level overview on the topic. It's not to provide you with detailed advice. However, if you require advice, we can certainly assist you afterwards. But one thing that I would always recommend when dealing with US tax is dealing with the tax code of over 8,000 pages with revenue rulings making up another 12,000 pages. So there's always the rule, which we will discuss today. There's an exception to the rule. There's an exception to the exception, and in certain cases, there's an exception to the exception. And in some cases, all those exceptions bring you back to the original rule again. So as I always say in adverts, do not try this at home and rather approach us for advice if you need any. As Anderson Global, we're now in over 300 and we're now in over 360 locations, over 160 countries in the world. So irrespective of how complicated you think your family structure or how complicated your asset structure are, we can certainly assist you from every corner in the world. Our US practice is by far our largest practice in the group, and over 2/3 of our US practice consists of private client work servicing exclusively high net worth individuals. As our seminar today, we will, if time allows, we will have a Q&A session afterwards. So please feel free to post questions as and when you see fit on the chat box, and I'll moderate them and we can address them afterwards. However, we've got quite a fair bit to get through today. So without further ado, I'd like to introduce the speakers and the experts on our panel today. Firstly, we've got David Roberts, who holds over 2 decades of experience. He's a managing director, over 2 decades of experience in advising clients on private clients on their tax affairs. He's practiced in the UK, Singapore, Miami, and New York before, and is currently managing director in our New York office. And we've also got Joe Toast with us, with over 36 years of experience in their advising high net worth individuals and private clients. And Joe's also a director of the regional Arthur Anderson. So it's great to have both of you with us. Joe and David, I'll now hand over to you.
Thank you, Ernest. Thank you for the introduction and welcome, everyone. Today, David and I will cover estate and gift tax issues for U.S. non-residents. We'll focus on estate and gift taxes with their 40% effective tax rate, which is confiscatory, but no discussion of estate and gift taxes can be complete without reference to corporate tax, individual tax, trust income taxes, and reporting and transparency issues. So we'll tangentially touch on some of those issues. We're going to assume that the wealthy person, or maybe even the not so wealthy person, is not a U.S. resident for estate and gift purposes. So they're living in a non-U.S. country for the most part. but we're going to assume first that they have U.S. assets, real estate or other assets, or they have a mixture of U.S. Assets and non-U.S. assets. And then we'll go on to cover even a little more complicated situation where they are not a U.S. person, but they have U.S. persons who are beneficiaries of their wealth, with or without U.S. based assets. And of course, if a person is not, if the person becomes U.S. resident, then the rules all change and he becomes taxable on a global basis. So we should start with that concept first. So David, if we would move to the next slide, first line of inquiry would be, is the person really a non-resident for U.S. tax purposes? And this is basically a facts and circumstances situation. There is no bright line test the way that there is for income tax purposes. So many of you know the so-called substantial presence test, and you count your days and you watch your, you know, a 3-year moving average and all that. That's an income tax only concept. However, when you look at the facts and circumstances, presence and where you spend your time is obviously one of the most critical factors in determining whether you'll be resident for U.S. estate and gift tax purposes. So they look at a list, and these are in many of the U.S. treaties also for income tax as well as estate tax, but they're going to look to the relative size of your residences in your home country and the U.S., the amount of time spent, where your center of vital interest is, where your children are, where your workplace is, and so there's a whole litany of items, but it is facts and circumstances. There's not a lot of law to guide you on this issue, and I would just make a point that we'll focus on later. It's not always best to be a non-resident of the U.S. Because if you become resident, as we'll see, the estate and gift exemptions are much more liberal than they are for non-residents. So watch what you wish for in this area. And it is also an area, since it's not a black and white issue, where there are capabilities to take aggressive positions if warranted in terms of whether you are resident or non-resident. So David is now going to cover why people own so many U.S. assets.
Yeah, thank you, Joe, and good afternoon, everybody. Yeah, so I think most of the people listening in probably have some exposure to U.S. assets, or they have clients that have exposure, because obviously that's the topic here and of interest to people. So I wouldn't be surprised if most people have some experience with this. But it really goes without saying that the U.S. market, the capital markets, are the strongest in the world. We often see a number of reasons that foreign nationals would invest in the US, and it can range from trying to access those capital markets to raise capital for businesses, to really just investing in equity or bond portfolios or private equity within the US, just for diversification, the stable currency of the US dollar, which I know that the South African rand has varied quite a bit with the dollar over the years, and an inflation hedge as well. But what people don't really always focus on is the fact that the US is essentially a tax haven in many ways. A foreign national investing in the US doesn't pay capital gains tax on equity sales, regardless of any treaty. That's just the US domestic tax code that says that. Similarly, if you earn interest on bonds, those are not taxable. And dividends, on equities, can be a 30% tax rate or a lower rate. So generally, it's a very tax advantageous place, in addition to all the other benefits I mentioned. However, as with the focus of this discussion, there is this big sort of thing that we need to be concerned about. It's the estate tax exposure. And people quite often overlook that when they're trying to get exposure to the US markets. And either they're not aware of it, or they don't think it's really so much of an issue. And we're going to kind of go through what this issue is and how we can best protect against it over the next few slides. Over to you, Joe.
So let's focus first on some of the basics so we can get everybody more or less on the same page. In the US, we have three types of transfer taxes. We have, and I think everybody knows there's a gift tax, there's an estate tax, but the third member of the trilogy is a generation skipping tax. And that's where you try to give directly to grandchildren or more remote descendants, great-grandchildren, so as to avoid a gift tax or an estate tax at every generational level. All three types of these taxes are at a 40% rate, basically. There's a very minor brackets below that, but it's basically a flat 40% rate. And so on this slide here, if you're U.S. resident, the reason I said that under the facts and circumstances, it's sometimes better to be a U.S. Resident. There's a this doesn't mean a citizen, just U.S. resident, $12 million approximately exclusion. So if you have $12 million of property anywhere in the world, it is exempt from estate or gift tax or generation skipping tax. And there's also an unlimited marital deduction. So when there's spouses, if one spouse dies and leaves everything to the other spouse, there's no tax, even if your assets are above $12 million. For non-residents, though, there's a dramatically different regime, but there's only a $60,000 exemption, but the non-resident is taxable only on his or hers U.S. situs assets, which we'll discuss in a moment. There still is an unlimited marital deduction if you leave your U.S. property to a U.S. Citizen spouse. And then if you move to the gift tax rules, they're even more draconian. There's no exemption. I mean, there's a small annual exclusion of $16,000, but there's no lifetime exemption. So if a non-resident tried to make a gift of a U.S. situs asset to either a U.S. person or a non-U.S. person, there's basically zero exemption. So if you tried to give a home in Miami or give art in New York or a car, an antique car, classic car, or jewelry that is considered a U.S. situs asset, then it's taxable almost from the first dollar. So you have to be very, very careful on these. We have had situations where we've had loaned art agreements, loaned jewelry agreements, where somebody is in the U.S. and wants to make a transfer of an asset to even just to another person, usually somebody dear to them, and you can set it up as a loan agreement to try to avoid the imposition of a U.S. Gift at 40%. So let's talk about U.S. situs assets on the next slide. We have a definition. Yes.
So not to interrupt, sorry to interrupt you, just one quick
do.
comment on your slides, just that it would seem pretty obvious, am I a US person or not a US person? But you'd be surprised at how many times we're having discussions with people and they actually realize that they actually are a US citizen as well, where the assumption is that they're not. But we find some people may have been born in the US and not really sort of focused on it and lived overseas for the most of their life. Or they may have been born to US parents, which, can actually make them a US citizen. So it seems like a straight black and white issue is, are you a US person or not? But we do have situations where people have resided overseas for many, many years. And actually, when you start digging, you actually find out they actually were, in fact, a US person and a US citizen. So you have to really think about these issues as well.
Well, there's a parallel. I'm glad you brought that up, David, because after World War II, a lot of Europe, particularly Germany, but also other countries, were very concerned about the Soviet Union being on their borders. So a lot of the wealthy, particularly German families, flew that when their spouse was pregnant, flew to New York or elsewhere in the U.S. So the babies were automatically U.S. citizens, so that they could always get out of Germany or other places. So and then they went back home, and of course, a generation later, they forgot or when they become prosperous 20 or 30 years down the road, and all of a sudden there's a lot of U.S. income tax issues as well as estate and gift tax issues. But you're right, you have to make the inquiry whether you're a citizen as well as whether, if you're not a citizen, are you resident or non-resident issue. So a non-U.S. person still is subject to U.S. tax if they own assets directly that are considered U.S. situs assets for U.S. estate and gift tax purposes. And for the most part, U.S. estate and U.S. gift rules define situs the same way, with one critical exception. And you can see these on the slide. Shares in a U.S. corporation are not taxable for gift tax purposes. So if you live in South Africa and you make a gift of IBM shares, it's not taxable. It's not considered a U.S. situs asset for gift tax purposes. However, for estate tax purposes, shares in a U.S. corporation are considered to be U.S. situs property. And David's going to cover an example that's perhaps a draconian result, but it occurs all the time. But the others are pretty obvious. You know, if you own U.S. real estate directly, personal property, with the two high-end ones being jewelry, art, sometimes collectible cars. We've had big wine collections over here. And some of the others, and the rules are a little tricky. You know, cash deposits with U.S. brokers or money market accounts are taxable, whereas bank accounts in U.S. banks are not. You know, cash is taxable if you're keeping actual currency or gold in the U.S., whereas intangible transfers outside the U.S. are generally not. And perhaps the biggest area of controversy for which there's no real guidance are partnership interests. You know, limited liability companies, either foreign or domestic, are the U.S. consequences and the U.S. situs. You know, you'd like to treat these as if they were intangibles and thus not situs in the U.S. But the U.S. government, and without a lot of guidance, the U.S. government apparently wants to look through these to where the actual assets are. So a foreign or U.S. LLC holding U.S. real estate or U.S. art or something like that, you run the risk of whether it's considered U.S. situs for estate and gift tax purposes. Next slide. David is going to cover an example.
Yeah, so sometimes the best way to give an example is to show a real dollar impact of how it hurts people. So this is a relatively simple example, but you know, an individual resident in Ghana, by example, they actually own a portfolio with Morgan Stanley. And the point here being that the portfolio doesn't necessarily have to be sort of custodied in New York or other places in the US. It could be in London. So we're using London as an example here. And within that portfolio, there's four types of assets. There's $1.5 million in US equities. And what I mean by US equities is shares in corporations that are actually incorporated in the US. So, you know, Joe, using the example, IBM would be a US equity for that purpose. The 800,000 in foreign equities, 500,000 in US issued corporate bonds, and 250,000 in cash, but in a money market account. And we're going to assume for that purpose that money market account is actually in the US. So, you know, the client now dies, and what is the consequence? Well, the highlighted items are what would be included in their US estate as US situs assets. So suddenly you've got a $1.75 million estate. The very miserly exclusion of $60,000 is not going to get you very far. It's going to reduce your estate by the first $60,000 is exempt, and you've got a taxable estate of $1.69 million. And the way the tax rates work is they go up to a rate of 40%, and that kicks in at a band of, they're graduated rates, but it kicks in at a band of just over $1 million. So you'd end up with $621,000 of US tax payable on this portfolio. Now, you know, as we'll go through, this is something you really shouldn't have to pay if you plan correctly, but it's very common that this occurs. And treaties can have an impact on this. For today's presentation, in terms of the geography, there's very few treaties that actually exist on the estate and gift tax side. So the US has a very wide network of treaties on the income tax side, but on estate and gift treaties, there's only about 15 that apply. And there's only one with South Africa in generally in the Middle East and African markets. So, and even that is kind of an older treaty that is based on situs, a situs treaty, but it would appear to give sort of the taxing rights to the jurisdiction where the assets are located. So it doesn't really achieve a whole lot from a treaty point of view compared to some of the other treaties. But always good, if you have South African residents, you should always be looking at the treaties, but anywhere else you would not necessarily apply. Just continuing this example from a practical point of view for a second. So, that was the numerical aspect of it. But what happens from a practical point of view? Well, the non-resident taxpayer dies, they have US assets. The heirs will reach out to Morgan Stanley and say, hey, Dad died, it's a tragedy, but we'd quite like our money now, thank you very much. And the custodian is not necessarily going to release those funds. It's going to wait. It's going to have a W-8 on file. It's going to know that this was a non-US person, and it's going to request a federal transfer certificate to show that the estate tax was actually paid on these assets before it'll release those assets. And what does that mean? Well, it means that an estate tax return has to be filed, the tax has to be paid, and then you have to wait a pretty considerable time for the IRS to actually process that tax return and issue the federal transfer certificate. So while all this is happening, those assets could be tied up for quite a period of time until that tax is actually paid. And another practical element we see sometimes is that there's quite a bit of assets are tied up in this in the US and subject to this tax. So where does the money come to pay that tax? If you can't access the funds, and you owe this tax bill and you can't get the money until you pay the tax bill, how do you deal with this chicken and egg situation? And it does become a real issue. Ideally, you find other funds to fund the tax, or what we've done in some situations is we've arranged with the custodian and their legal counsel that they will release the funds, provided they are to pay exclusively just to pay the tax. But anyway, these are practical considerations that people don't think about as well, that there's a time lag between when you might actually get the money as well. Okay, Joe.
Yeah, so it would be a shame, if not a pity, to pay U.S. estate or gift taxes, particularly if you have no U.S. beneficiaries. But as David indicated, it happens quite often. So we'll now look at some ownership options for non-residents so that they can hold their assets in such a manner so as to avoid U.S. estate and gift taxes. And we'll also make some comments about income taxes also. So direct ownership or through a foreign grantor trust, which is treated for U.S. purposes as if owned by the wealthy person. If you have U.S. situs assets, including U.S. stocks or basically U.S. stocks, U.S. real estate would be the most common, but also art if you own U.S. real estate. Or we've seen all taxable above $60,000. To avoid that, a foreign corporation, an entity that is treated as a corporation in both for U.S. purposes, serves as a blocker. And this is the most common structure that we see used globally, is to use a foreign corporation to hold U.S. assets that would otherwise be taxed. So it's very, very popular, but it gets complicated if U.S. beneficiaries are going to inherit that foreign corporation. But if you have no U.S. beneficiaries and you just house your U.S. based assets, U.S. situs assets in the foreign corporation, it serves as a very effective blocker. A foreign irrevocable trust works fine, particularly with U.S. securities. If you make, for U.S. purposes, a completed gift of those U.S. securities, keep in mind there's no gift tax in the U.S. on a gift of U.S. security. So if that Ghanaian person that David referred to had made a transfer of those shares to a foreign, or for that matter, it could be a domestic irrevocable trust, but he'd have no real interest in using a domestic U.S. trust unless he had U.S. beneficiaries. But a foreign irrevocable trust, he could have avoided that result and by transferring the shares into the trust. And incidentally, the trust, once the shares are titled in the trust, there's no need to change the title. So there's no need to even ask Morgan Stanley for a transfer certificate because the trust would continue and there'd be no need to even ask them. But nevertheless, a completed gift of the U.S. assets would be effective transfer. That's more difficult to do if you have U.S. real estate, because then you bump up against the gift tax rules, because in order to make a completed gift of a U.S. situs asset for gift purposes such as real estate, then you don't have any real exclusions and you make a taxable gift to fund it. So some try, if they don't like the foreign corporation because there might be adverse income tax consequences to it, some try to use a foreign or domestic LLC taxed as a partnership or as a disregarded entity for U.S. purposes. And if that entity is, the inside assets of it are U.S. situs, you're bumping up and you try to make a gift or pass it through your estate, you're taking a chance that a modern day limited liability company would not be subject to U.S. estate or gift taxes. And that is, as I said, there's no answer to it. There's only conjecture. I'm of the camp that believes that it should be treated as an intangible and that it should not be taxable. But you have to, be careful. My thinking on that is not universally agreed to, but it certainly is an area of current controversy. On the next slide, we'll look at just a simple example of a foreign corporation as a blocker. On the left side, we show a typical structure where we just have passive investments. The U.S. assets are IBM stock and Microsoft and other types of U.S. private equity and things of that nature. And by housing those in a foreign corporation, we avoid U.S. estate and gift tax issues upon the death of the owner. And of course, he can own his non-U.S. assets any way that he wants because they would not be taxable regardless. If you have active business investments in the U.S. or active real estate investments, you sometimes get perhaps a more complicated structure where you have a foreign corporation with a U.S. corporation to hold the U.S. operating business assets or U.S. real estate assets. And this one works as a very fine blocker for estate and gift tax purposes. And the foreign corporation should block from U.S. taxation, U.S. estate taxation, any real estate or other operating assets in the U.S. But there's some questions as to the income tax efficiency. And to the extent it does own U.S. real estate, you need to watch. The U.S. has a very comprehensive system for taxation of U.S. real estate interests, affectionately known as FIRPTA, which stands for Foreign Investment in U.S. Real Property. And so you have to be careful, but sometimes the exit strategy is to sell the foreign corporation and have no U.S. estate tax or income tax on that structure. So David is now going to talk about use of trusts as blocker type entities.
Yeah, thank you, Joe. So there are really two sort of core blockers, if you like, that serve. One is the one Joe just described, where you actually have a foreign corporation because you shift the situs from the assets outside the US to basically shares in a foreign company. And so when you die, that's where you're holding, and that's how it protects from the estate tax. The other thing is you can just simply not own the assets at death, which is if you are using an irrevocable trust and you die and those assets were transferred to the trust in the form of a completed gift, then those assets will again not be included in your estate. As we'll discuss over the next few slides, even though this is effective and can be effective from an estate tax point of view, if you do have US beneficiaries, this type of trust would need some additional planning on top of it to make sure that you don't create an adverse consequence for your US beneficiaries, either at the time of distributions from the trust. A couple of just technical things to mention. Foreign, when we talk about a foreign trust, obviously we're talking about foreign from a US point of view. And these things are defined in the statute. A foreign trust is essentially one which is a foreign court has administration over the trust, or a foreign person can make substantial decisions over the trust. So it's generally very easy to make a trust foreign from a US point of view. You just need to have a power holder who's a foreign person, and you've got a foreign trust from as we go through definitions. We see this a lot in the international context where, for home country reasons, people may use an irrevocable discretionary trust. They're trying to do some planning on their domestic side. They're getting the assets out of their name into the trust. You just want to make sure from a US point of view that that is really still considered a completed gift, because what you wouldn't want is those assets, even though you think you've made a completed gift, those assets to actually remain in your estate because it wasn't really effective. And the US essentially defines things if you've retained incidents of ownership within the trust. So you could have some sort of powers of appointment over, where those assets in the trust are directed, or you have a beneficial interest in those assets after you've transferred them. These are things that need to be looked at carefully to make sure that trust really is a blocker from an estate tax point of view, and the US isn't going to simply say, that's fine, you put your assets in a trust, but technically you still own them for estate tax purposes. So just we put in here domestic non-grantor trust. There are situations where this may be applicable. Again, when we're in the context of non-US beneficiaries, there's probably not too many reasons we'd want to use a domestic, what I could refer to as non-grantor trust. And the primary reason behind that is that if it's a US tax, it becomes a US taxpayer. So what you've done is you put those assets into the US income tax system as having an actual US income taxpayer now. So not always a great solution from a US if you have no US beneficiaries. If you do have US beneficiaries, it may be something further to consider, but I just wanted to mention at this point. Not the ideal
David,
solution.
I would just add on that, you sometimes see it to act as a blocker for US income tax purposes. If the domestic irrevocable trust has a US sourced income, say from an operating pass-through business or real estate income, and the foreign owner doesn't want to file a US, a non-resident income tax return for privacy reasons, a domestic or irrevocable trust can serve as a blocker at probably effectively the same tax rates, but it keeps the foreign person off the US radar.
Yeah, that's a great point, Joe. And again, we're looking at this through the lens of US tax system and legal system, but when we go back to looking at a foreign corporate blocker, those don't always make sense from a domestic tax point of view. I mean, a lot of countries have their own controlled foreign corporation or tax haven legislation that can make it an ineffective solution. So eliminating the corporate blocker and using some sort of just pure trust structure can make sense in that instance.
Thank you, David, and thank you, Joe. I think that is very useful. I did have some questions that came through, but I think I'll leave it until we deal with the next section of the presentation prior to addressing those questions. Two things that I think is worth mentioning is the estate treaty between South Africa and the US that you referred to, I think dates back to the 1950s, and I can assure you that nothing good came out of South Africa in the 1950s. So I'd highly advise that you do not rely on that treaty because it's not of much use. However, in South Africa, there are a lot of domestic rules on the restructuring of your assets to ensure that you can transfer assets either into a local company or into a trust, not into a trust that I need to qualify. That's not a topic for today, but into a qualifying company in a tax efficient manner, and effectively creating that blocker. However, so but that's a point of domestic advice that we can provide, and then also obviously, and a lot of people tend to use Mauritius, who's got similar type legislation and are very lenient on CGT. But let's move on to the next topic, and we can always get back to the questions on US estate duty. We're now going to look at just families with family trusts and setups with US beneficiaries, and what the impact on those trust assets and what the impact of distributions from those trusts may be on US based beneficiaries. But David, Joe, I'll hand back to you.
Yeah. Thanks, Ernest. Just one final comment to make along the lines of what you said. What we talked about today is structuring assets without consideration for US beneficiaries. It's really just, you've invested in the US, you're protecting those. For the most part, if you've already made the investment particularly in intangible assets like stocks, securities in general, you can probably restructure that quite relatively easily, with making sure you follow the right advice to get an estate blocker of some sort in place. Where it becomes a little bit more complicated is on real estate. As Joe mentioned, gifting real estate is a real issue because you've now got a tangible US asset. And also, even if you don't necessarily have to worry about the gift side of things, you have to consider other elements. Like we have a transfer tax. Like in New York, for example, you pay 2% transfer tax on change of ownership. So you could buy a property and then realize a week later you should have done something different, and then you want to put it into another legal structure. You could end up paying a 2% of the purchase price just for that restructuring cost. So it's always best to think about how to purchase rather than purchase and then transfer. But in most cases, you can probably fix it as long as you are thoughtful about how you go about the process.
And I would just add into that mix, David, watch out for deathbed blockers, that a simultaneous creation of a blocker followed by either a death or a gift adds another degree of complexity. It's not to say don't do it or don't try to do it, but an aged transaction is much more likely to pass muster than a simultaneous one.
Yeah. Great point. So we'll turn our attention to families that have US beneficiaries for the moment. And, so this brings in a whole bunch of new considerations, as you'd expect, and just highlighted some of them here from a sort of questions point of view as to what the type of things you'll need to be thinking about now with US beneficiaries. Obviously, the first one is, will you be making the transfer directly, whether lifetime or death through, directly to an individual, or will you be doing it through some sort of trust structure? How had you contemplated the structure you had in place? When does the event is going to take place? Are you going to do it during lifetime or at death? Sometimes when you've got US beneficiaries, you really do want to consider making lifetime transfers to them, whether, it's to buy, they may have moved to go to college and they will now want to buy a piece of real estate or something, and you sort of make the gift during lifetime, or you wait until death and you sort of transfer the assets at death. Obviously, the thing that's near and dear to our heart is will the transfer be taxable? Will it be subject to gift tax on the transfer? What is the situs that's asset, as we've discussed? Will the transfer be reportable? And we'll explain a little bit the consequences of non-compliance with that. And then, very importantly and often overlooked, what is the cost basis? If you're transferring non-cash to an individual, what is the cost basis of that asset going to be in the hands of the US person? Bear in mind that US person is subject to worldwide taxation. This becomes a secondary issue, but it's an important one to be thinking about. And then also, how will those assets be taxed to a US owner? So we talked about a foreign corporation as a blocker. If that, upon death, that foreign corporation now goes to a US person, is that a good idea for a US person to be owning shares in, say, a BVI company that holds passive investments? The very quick answer on that is no. And we'll go into a little bit more of the reasons for that as well, but we won't dive too much into that. Okay. So Joe, do you want to cover this one?
Yeah, sure. So let's look at some of the basics. And first of all, a rule that we get asked all the time is if somebody is either a U.S. citizen or U.S. resident, they can receive a gift or an inheritance or a generation skipping transfer without any U.S. income tax or estate or gift tax, because the U.S. transfer tax system, gifts and estates, applies to the donor. So if the donor is a foreign person, there's no tax to the donee. Now, of course, the donor. So all the focus is on the donor. But if we're talking about non-U.S. situs property, for example, if you make a gift of cash outside the U.S. to a U.S. beneficiary, then it's not taxed at all. So there's many wealthy South Americans and Middle East, Africa, Europeans that are living in the U.S. Strictly based on gifts of cash from their parents who are not U.S. people. But there are reporting requirements. So there transfers of more than $100,000 US in a given year are reportable but not taxable. It's an information reporting concept with fairly steep penalties for failure to comply. There are some income tax issues because lifetime gifts have a basis carryover, so that if you make a gift of foreign real estate to a U.S. person, then the tax basis carries over to the U.S. person. So if you were in South Africa and you made a gift of South African farmland to a U.S. beneficiary, they take over the historical cost. There's no step up, meaning that when the U.S. person turns around to sell it 5 or 10 years down the road, it would not, the tax cost would be the old historical cost to the donor, not the value at the time of the non-taxable gift to the U.S. person. And once the assets are gifted to a U.S. person, they are then owned by them, and now they're in what we call the estate and gift tax regime in the U.S., which is maybe okay if they're under $12 million, but if you made a humongous gift of foreign assets to a U.S. person, you might want to consider using a perpetual trust. And we'll talk about that as a way to avoid U.S. estate and gift taxes forever.
Yeah.
The next two slides. Yes, David.
Sorry, just a quick comment on the penalty, because I can't emphasize enough how draconian these penalties are. You would think it's a simple error of not reporting a gift that would not otherwise be taxable. But when you're talking about a multi-million-dollar gift, as you can imagine, a 35% penalty is very substantial. And the IRS is pretty strict on these penalties. I mean, they will issue a penalty notice for late reporting or underreporting on these items, and they will and they'll be quite strict about the reasonable cause. If you simply, normally you can abate penalties in the US if you write a very strong letter saying you had reasonable cause for, you didn't understand the rules or whatever. But on this particular issue, the IRS has come back and said, we don't buy it. You had tax advisors, or you should have known the rules, and we're going to continue to assess these penalties. So something to be very mindful of is when you are making transfers to US people, how draconian these penalties are.
The next two slides just talk about the definitions of a foreign trust. David touched on those. I won't repeat that. I would just say that there's a black and white way to have either a foreign trust or a domestic trust, and you're at your peril if you move out of the black area or the white area. If you get into the shades of gray, you better be dealing with somebody who knows what they're doing, or else you may have a trust you think is domestic, but it's really foreign, or vice versa. So David, I think we'll now talk about a typical structure of a foreign grantor trust.
Yeah, so we're kind of simply revisiting where we were a few slides ago, where you've got US assets in this case, and you've got a blocker structure in place, as we defined. So, keeping it simple, that we have a foreign grantor trust. I mean, it could be an individual or a trust, but it now holds a foreign holding company, we'll refer to as FC, which holds the assets. So this is your blocker, but now you've got a US beneficiary in the mix. So, you know, the advantages you had the US estate tax protection. The foreign person didn't have to file tax returns because that corporation was a blocker. So even if it had certain types of US source income, the individual wasn't filing a tax return during their life. And generally it maintains privacy, which is a good thing from that point of view. However, the main issues that arise on death now is that if the trust is to terminate and transfer that foreign company to a US person, that US person now owns shares in a foreign corporation. And as I mentioned or alluded to earlier, if that foreign corporation owns passive investments, it's not a very effective solution because we have a lot of anti-abuse legislation in this area where controlled foreign corporations are taxed adversely if they're essentially holding passive investments. There's no reason to be doing that essentially. So what they're trying to discourage is a US taxpayer parking their money in the Cayman Islands and saying I don't have to pay tax on it because it's held in an entity. So these rules are really designed to have a US person now owning a foreign corporation. It doesn't make a lot of sense, and what you'd want to be doing is trying to get rid of that foreign corporation rather than actually have it transferred to the individual. Importantly, we talked about basis as well, and this is often overlooked as well because there's a difference between inside and outside basis. So when somebody dies, the foreign person dies, generally, and what Joe mentioned, if you give a transfer during a lifetime, you normally don't get any kind of a basis adjustment. The individual who receives those assets receive the same basis that the donor had in it. If instead they receive assets on death, then there's a step up, generally a step up in basis to the fair market value. So all of that appreciated gain that had taken place during lifetime suddenly disappears from a US tax point of view, and you inherit at the full fair market value. So that's great. Now the US beneficiary, when they sell, they don't have a US taxable issue on the gain, on that appreciation. Well, that's not exactly correct if you have this type of structure, because what happens is the basis step up is only for the outside basis, so at the foreign corporation shares, but not the underlying assets themselves. So it's an issue what we could refer to as the outside-inside basis issue. And I'll demonstrate that on the next slide here, where just a very simple example to try and explain. You know, the foreign corporation owns Amazon stock, which they've held for quite a long time. The person had a crystal ball, I guess, but they purchased for $5 and it's now worth at the date of death $100. Now there's no estate tax. That's great. The blocker was in place, but the US beneficiary will receive the shares of the BVI company with a tax basis of $100 at the fair market value. That's great. But the Amazon stock still has a basis of $5. So when the US beneficiary goes to liquidate that company, there's going to be a $95 gain on the liquidation of that company that's, you know, that could have easily been avoided. So one thing to consider is just very carefully is, you know, if you're using the structure of a foreign blocker corporation and you have US beneficiaries, we need to be doing a lot of basis monitoring and thinking about how we can step up that basis upon death if on the transfer. And the solutions really are, you know, a very basic one. You can continue to churn the assets in the portfolio, assuming there's a marketable and liquid. You know, so you could keep continuing an active portfolio so that when you die, you're going to have a reasonably high basis or close to the fair market value. You could do a little bit more complex situation, I guess. You know, because you've got a corporation, you can actually dividend out that income up to the trust and then recontribute it on a periodic basis. So that kind of cleanses the, you know, keeps the basis high in that format. Or there's strategies which you can employ which actually can eliminate the issue altogether by using what we refer to as the check the box regulations in the US, where you can make elections to essentially liquidate the company. And thereby the liquidation will be a sale of the underlying assets and get the step up in basis that you require. It's a little too much involvement to go into this in detail in the time that we have today, but what you're trying to deal with here in this situation is if you check the box and to make it a disregarded entity, you've lost, and you do that before somebody dies, you've lost your estate tax benefit because now you've got a disregarded entity that owns the assets that are going to be included in this estate. If you do it after the date of death, you've lost the benefit of it, and you've got the estate blocker, but now you've still got the basis issue, and you're going to be triggering that basis issue. So there are more complex structures that we put in place, which effectively use 3 corporations, and you can get the basis step up by making multiple check the box elections. But we won't get into that for the time being. But just to understand that the prior structure of a corporation owning out US assets needs to be extra level of thought when you've got that transferring to US beneficiaries. Sure, there'll be a lot of questions on that. So, Joe, do you want to cover this? Yeah.
Sure. So either for lifetime gifts, usually of non-U.S. property, including gifts of U.S. stock, or at death time, the transfer of assets to a U.S. dynasty trust rather than directly to the U.S. beneficiaries is often the right way to go. The primary reason being that the trust structure, the beneficiaries can have either open access or largely open access to the assets, or they could have more restricted access. But the trust basically prevents the assets from ever being subject to U.S. estate gift or generation skipping tax. And one of the problems is who should be trustee of those. And most of the trusts that we help to design, a lot of our clients, both U.S. and non-U.S., are control freaks, so that they're willing to make a gift, but they want to be able to control it. And they feel as though if you have to use an institution as a trustee, that you can't control it. Individual, you might be able to control, but you might not fully trust them. But most of the situations, you have removal powers and replacement powers over the trustee, so that effectively the trustee does the bidding of the donor, at least while he's alive, obviously. And thus the donor, through control over the removal of the trustee, can effectively control everything. The other way that control is maintained is that often the asset of this dynasty trust is a controlled entity, like a limited liability company in the U.S. And so you can have double belts and suspenders on the control, because the wealthy person controls both the LLC and the trust through control over the trustee.
Okay.
So David, you want to talk about more about non-grantor trusts?
Yeah, I'll just cover these, and then that'll bring us to our summary, and then we can address any questions that have come up. So we talked a little bit at the beginning again about how you can use a trust, an irrevocable, and I'll use non-grantor and irrevocable interchangeably, although technically it's not the same thing, as a blocker from a state tax point of view. But I said it wasn't necessary. If you're using a foreign non-grantor trust, it's not necessarily the right solution if you've got US beneficiaries. And the reason for that is that the US has a set of rules where they look at it from the US beneficiaries point of view, and they assume that anybody who has an interest in a trust that is offshore, that is accumulating tax-free, is getting some benefit that shouldn't be available to US persons. So even though they just have a beneficial interest rather than its assets they own, the US tries to capture this. So what they're essentially saying is that if you have the assets that are growing offshore tax-free in a trust, when you make a distribution from that trust to a US beneficiary, they will tax the beneficiary on the income they receive from that trust. They'll say you can have the deferral, but the minute we get the money into the US, we're going to tax you on that income as a US beneficiary of this type of trust. And the reason being, because when we went back to foreign grantor trusts, it was quite clear that somebody else is being taxed on the income, the grantor in that instance. But here, nobody's being taxed on the income. It's a trust that owns the assets. So effectively, the US is saying we'll get our piece of action on the tax. Now, that might not be the worst thing that could happen, and you normally see this after the grantor has died, so nobody's going to be taxed on it. So if the assets had gone to the US person, they'd pay tax anyway, so no harm, no foul. Well, it is, because what happens, and the negative aspect is, if the income accumulates in the trust, then the IRS actually applies a throwback tax. So you have this a beneficiary of an offshore trust that's irrevocable, grantor has died. It makes $1,000 of interest year one, it doesn't distribute it, and now it makes $1,000 in year 2 and distributes out all $2,000. Well, what happens? Well, the first $1,000 is taxed normally. The second $1,000 is actually taxed as an accumulation distribution, and an interest charge under these throwback rules will apply to that charge. So basically, the IRS is saying, okay, you're not getting any kind of deferral. We're going to hit you for an interest penalty under these punitive rules on the distribution. The other aspect of it is that you lose preferential tax rates on an accumulation. So the US, we have a distinction where if you have assets you hold more than a year, you pay 20% capital gains tax versus a highest rate of 37. And similarly with certain types of dividends, all that goes away and everything is taxed at 37% on an accumulation. So the bottom line is accumulating income offshore for the benefit of a US person in one of these type of trusts doesn't always make sense. However, there are some exceptions to this. You know, if you distribute out all of the current year income, then you just pay ordinary taxes like you would a normal US payer, so you can avoid accumulations. And the IRS actually does give you 65 days after the end of the year to calculate and make the distribution still counted as a prior year distribution. The other elements are you can include in the trust document itself, you can have 3 specific gifts directed in the trust. So you could say, you know, $1 million age 25, $1 million age 30, $1 million age 35, and those won't be considered to be accumulation distributions because they're specified gifts up to 3. And then there's a couple of other methods, one of them being trust accounting income, where you can play with the accounting numbers of it to essentially avoid some of the accumulation distributions as well. We won't get into that. We don't really have enough time, but you know, bear in mind that this still has some benefits. This type of structure, it does protect from estate taxes in perpetuity generally, but you've got this adverse thing when you want to distribute out. I would say if you have temporary beneficiaries in the US, so if they're here for 5-10 years and you know that eventually they're going to leave, this is not a bad structure because you just don't make distributions while they're a US person. That can still work in that instance. I'm conscious we're running out of time, so what I'll do is I'll just jump to the last. I'll let Joe, if you don't want to just summarize quickly, and then I don't know, Andy, if we have time for a couple of quick questions.
Yeah, we have more time, Ernest. If you do, we can go another 10 minutes or so. But just the summary, quick summary. The U.S. estate and gift for a non-resident U.S. estate and gift tax, including U.S. situs assets, is a voluntary tax. With careful planning, you can eliminate it. Without careful planning, you can incur substantial U.S. estate and gift tax purposes. So if you like to pay tax, don't do any planning. Basically, the U.S. is very friendly to foreign investors, and the U.S. disclosure rules are also very friendly. You know, there's a lot of the use of a lot of the U.S. trusts and U.S. limited liability companies. There's more reporting on foreign ones in some jurisdictions than in the U.S. So there's a lot of privacy and confidentiality. Currently, there are some proposals in process that are going to change that, but currently there's a lot of privacy. So I would just leave you with careful planning and not last minute planning, you can make this a voluntary tax in many situations. So Ernest, do you have questions, or if questions come in?
Thanks. Thank you, David. Thank you, Joe. That is very useful. Yeah, it's I think there's a great seminar. I've received 2 questions, which I am going to address with you, but we have run out of time. So if anyone needs to leave and excuse themselves from the meeting, we will not take offense. And it'll be quick, and then we can summarize, and we'll be done within, I reckon, within the next 5 minutes. The first question that I've received retains to control, and the question is, if a foreign settlor retains the ability, retains the power to remove and replace the trustees, does that drag the trust into what's deemed to be a revocable trust, or is the revocability only with respect to the trust assets the trust being revoked and the assets vesting back into the name of the settlor?
Ernest, it's the latter. The removal powers over the trustee, the IRS has ruled many times that the donor can have the ability to remove and replace the trustee as long as the replacement trustee is not a related or subordinate party. So you have to replace them with somebody who's not related. So it's very clear that you can retain that level of control. So we often see totally discretionary trusts, so that the terms of the trust say the trustee can distribute all or any or none of the income or assets to any or all or none of the beneficiaries in any given year. And then the donor has removal powers over the trustee. So who really controls that? It's still the donor, but that it is not considered a revocation power, such as to prevent it from being a completed gift or being included back in the donor's estate for U.S. purposes.
Perfect. Thank you, Joe. I think that's it. That clears that issue. Second question. I'm not sure if I it looks like quite a difficult question, but it came through. It says, am I correct in my assumption that a foreign grantor trust with discretionary U.S. beneficiaries may be better for income tax purposes, whereas a foreign non-grantor trust may be better for estate tax purposes?
So I can take that, Joe, at least initially. So you have to really define what is a foreign grantor trust to be clear as well, because that retains it as a foreign income taxpayer. So it's really disregarded for income tax purposes, if you like. The foreign owner is the one who's taxed, and it's quite effective. It really is, as we touched on, there's two reasons you'd have a grantor trust, and this is defined very clearly when you have a foreign grantor. One is that the trust is revocable, or the other situation, it can be an irrevocable trust, but the only lifetime beneficiaries can be the settlor and the settler's spouse. So if you meet those two requirements, you have a grantor trust, a foreign grantor trust. And in that instance, yes, the income is taxable to the foreign person. Now, you have to look at what type of income you have, because certain types of US source income could still be taxable, like if you have rental income or things like that from the US. If you have but that doesn't, without a blocker corporation, that's not going to do anything for you from an estate tax point of view. The irrevocable trust, if it's structured properly as a completed gift, would give you the estate tax blocker, and it becomes its own separate taxpayer. So it's still a foreign taxpayer. So the same set of rules apply. You may have shifted the jurisdiction of the taxpayer to where that trust is located rather than where the grantor is located. But essentially it's still a foreign taxpayer from a US point of view. But if you're relying on some sort of treaty for income tax treatment, you're probably not going to be getting it through a trust, because you're probably not enabling yourself of treaty benefits for that trust, because it probably doesn't have enough nexus to a country. I hope that hope that answers.
Yeah, that's great. I think that certainly answers the questions. Got one more question here. We asked, how are distributions from a foreign grantor trust to U.S. beneficiary who is a minor treated?
Just the same
Well, if
way.
it's from a foreign grantor trust, there's no taxes, because it's a tax-free distribution, because it's taxable to the foreign person. It may be difficult to make it a foreign grantor trust under those circumstances for the reasons David mentioned. It would probably be a revocable one if that were the case. So
yeah, but they would still have the same reporting obligations that any other U.S. taxpayer had. Just because they're a minor, they would still have to file the reporting of the gift.
3520. Yes. Yep.
Yeah. Thanks, Joe. Thanks, Ed. I think that looks like that concluded the questions for today. One last thing I think worth mentioning is, contrary to 10 years ago, everything is now reportable. We do have FATCA in place, so the time have come where you relying on non-disclosure is no longer an effective, and should never have been, an effective tax planning policy. But especially now with gift taxes, we're going to see this coming up more and more. So if you have any questions, please feel free to reach out to us. Then, Joe, David, thank you for your time today. Really appreciate it. I think it was a very insightful presentation. We will be circulating the slides, and please feel free to reach out to any of us if you've got any questions. But yeah, guys, that's all for today, and thank you very much for your time.
Great.
Thank you.
Thank you. Have a good day, everyone.